Hello, folks. Great to be back again. I'm Rajeev, managing partner at Rise Venture Partners, an early stage VC with close to 100 startups and quite a few unicorns. Well, over the past few weeks, we have seen a lot of interesting developments. Some Fed rates have reached a 17-year high. The US inflation has reached a 2-year low. Regional banking crisis continues to yo-yo. And now we are staring at a debt ceiling standoff between the Reds and the Blues. And the Feds. We cannot talk the economy without mentioning them. A very confusing time indeed. To understand what's happening and what the trends suggest, we have invited Mish, who is an expert guru in the markets here. Mish, thank you so much for joining us. I know it's very early for you there and really appreciate your being able to make it. And we look forward to the session, really. Michele Mish Schneider is the chief strategist at MarketGauge.com, an industry-leading financial publishing company. Mish was one of the first female floor traders on the New York Commodities Exchange and the World Trade Center. That must have been an interesting set of anecdotes, Mish. She also serves as a partner in MarketGauge Asset Management Company. She's a frequent guest on financial media, including Bloomberg, Fox Business, CNBC, Yahoo Finance, and Real Vision. Today, Mish will cover a lot of ground on commodities, key growth trends, inflation, stock markets. She has a very unique way of analyzing the stock market macro picture, which she calls the modern economic family. We in the East, Mish, as you know, tend to be a little bit more family oriented. So that already starts to feel a little bit more familiar here. So look forward to, hearing this. I'm really looking forward to, getting through the next 30 minutes or so, where I'm going to ask Mish to take the center stage. Folks, you don't need to make any notes because we are happy to make this conversation and the presentation that Mish is going to make here available after. After this, we'll move to the Q&A discussion. Please type your questions in the chat. We'll definitely get to them. I look forward to a productive 45 to 60 minutes. And without further ado, Mish, over to you.
Well, good morning or good evening. Thank you so much, Rajeev, for that wonderful introduction. And yes, I'm hoping that by the end of our session together, you have a general idea of sort of the macro to the micro and why this year has very much been a year of a square peg trying to fit into a round hole, which has been baffling a lot of investors because people like to look at historical data and old rules as the eternal rules. And we know that nothing is forever, right? Except for a couple of things. So, but in the market, certainly nothing is forever. So that's been very much the theme this year. And at the very beginning of the year, in December, actually, I had this very clear vision about what I would potentially expect to happen. And when I get that kind of clarity, where things go awry is when you start to get seduced, if you will, by other viewpoints and swayed by sort of short-term moves. So I'm going to go back to where I originally began this year because so far it's playing out well with a couple of surprises. So I'm calling this investing across US and global markets. And actually a couple of interesting statistics have come out. We've got new 52-week highs in Japan. They've been struggling for years to come back to their peak days back in the late 80s. Germany just reached 52-week highs in terms of IMF. They said China and India are still the largest growing economies right now as far as developing countries. Emerging markets still somewhat behind. And here in the US, we have our own interesting situations to look at. As you know, in the US, besides central bank driven, we are also very politically driven. And of course, we're going into an election year. So let's go through it and I will give you the vision that I've had, where we are and what we can expect as we go forward. So please, Rajeev, next slide. Well, you went through my bio, so I won't repeat it. Thank you. There are just some nice pictures of me on media. So let's go into the outline. Well, I'm all about relationships. And as Rajeev pointed out, I have a family, which is also about relationships. And when I say a family, obviously I have an actual family, but in the market, I've created a family. So what we're going to do is we're going to start out by looking at some of the classic market breadth relationships and how they are often so ahead of the curve. And what are they telling us right now? Certainly, we're going to look at my economic modern family, which I think you're going to find very interesting. There are characters associated with them. I'm probably not going to show the characters, but I'll tell you where to get them. We'll just talk more about the theories behind them. And of course, as a commodities trader, as Rajeev pointed out, I spent 14 years on the commodities exchange in New York, traded pretty much every commodity there was, really kind of where I cut my teeth. We're going to talk about commodities because they've become very much in vogue again. And then I just want to spend a little time on some of the key mega trends that we're seeing and talk to you a little bit about discretionary trading versus algo trading and what we're doing here at our company that's really taking advantage of a blend approach. So let's get going. Okay, so here, and we're going to talk a little bit about this because this is an extremely important chart. This chart actually started to flip, and I'm going to show you all the different relationships in a moment, but tell you that this actually measures risk on, risk off. This is part of our big view that we have on our website. And essentially, we like to look at the relationships. So people keep talking about the yields are going higher, and that's true. But it's much more important to us to see whether or not the long bonds, for example, which is what we use the TLT versus the SPY or the S&P 500, what is the relationship between the two? So at this point, what we're seeing now is the red line is really the ratio and the lines are the measurements. So you can see right now that the SPY is outperforming the long bonds. Why is that important? Because it really makes people who have been calling for recession look like more of a wish on their part. And there are many, many people who want to see this market go down further, want to see the economy crash for all different kinds of reasons. But the actual fact is right now, with the SPY outperforming these long bonds, it's telling us that it is possible that we actually may achieve some type of soft landing. That's not necessarily the same thing as bullish, but it certainly could divert us from feeling like we're going to have a major crash. The next relationship is one that I really love to talk about, and most people don't really focus on it, but it's the junk bonds as we see through HYG, which is the ETF. So what are junk bonds? They're high yield debt bonds that pay on companies that have really poor balance sheets. So they're junk companies, literally, but because they're junk companies with poor balance sheets, they pay a very high yield. So that is the ultimate risk-on situation when companies and bond traders want to buy these type of scenarios. Obviously, they feel that the market has some legs. So with this particular ratio, again, the junk bonds versus the long bonds shows that right now there's money going into the junk bonds. That too is a risk-on situation. The third chart, and we're going to talk more about gold because gold is sleeping right now. But in terms of the relationship to the SPY versus the gold, we're still not fully outperforming because we haven't crossed the second line. And we don't need to go into the explanations. We can just keep it visual. But you can see over the last few days that the gold is now underperforming the SPY, which of course is another risk-on situation because gold is often a flight to safety. And we're going to talk more about gold. And then the fourth chart there is wood, which is a great measure of the US economy versus gold. And so considering wood is something that's used in all types of development from commercial to residential, right now what you can see is surprisingly the wood is now starting to outperform. And here in the US, you're getting tremendous calls for some kind of housing crash, none of which I believe is going to happen. I think this is just an adjustment to the norm, and we won't get too much into that. The last chart just shows the SPY, but there's one more relationship that I don't have on there, but it's really probably the pinnacle of risk factor, and that would be utilities versus the SPY. And if I showed you that chart, you would see that right now the SPY has really flown in the face of utilities. So utilities are another flight to safety. And generally, again, if we're going to see a market that's under stress, you're going to see the money going there. So we have dodged a lot of bullets, right? We have dodged the bullets of the banking crisis. We've dodged the bullets of the incredible speed that the Federal Reserve raised the rates. We've dodged the bullets of inflation. We've dodged the bullets of labor in some areas with lots of layoffs, so yet still a very strong market. We've dodged the bullets of some softening, obviously, in the job market and the housing market. And we've also dodged bullets really in terms of just what's happening here in the United States in terms of all the political strife, although that's always going to be in the back burner. So there you go. This is a real proof that you have to have some idea of what's happening under the hood, so to speak, to really make an educated decision. And of course, we are not passive investors. We'll talk about that more. We like to do more active investing. And right now, this has been telling us that to put cash to work is probably not a bad idea. Let's move on. Now, the real key, and of course, the expression "don't fight the Fed" is obviously a very important one. We certainly saw that from all the accommodative policy that it had throughout the years, and then in 2022 when they totally pivoted. And so what the Federal Reserve looks at, seasonality-wise, May is often the peak in terms of Fed funds rate and yields. And what they would like to see is that the Fed funds rate is actually higher than the CPI. And if you look at the last, what it says today, really we're looking at this most recent information that came out on CPI, which really is from April. We haven't gotten May numbers yet. We'll get that in June. But you can see the Fed funds rate in green is 5.25%, while the CPI was 4.9%. So right now, no matter what people are saying, no matter how much hawkish talk you're getting from Fed members that constantly seem to be jabbering, this is actually telling us right now that the Fed has a legitimate reason to pause, and that too is in the market. Of course, the other factor is the debt ceiling, and right now the talk is that the debt ceiling is going to be resolved, and we're going to talk about the vision on that too in a moment. Let's go to the next slide. Okay, so this brings me to my economic modern family. So that's all kind of the backdrop, and it's good to understand what really makes a good investor and a good trader is being able to look at the macro, bring it down to the micro, and then make decisions based on actual technical analysis. So we like to use a very hybrid approach in that I like to know what's going on, obviously, in terms of everything I just showed you, what's happening with rates, what's happening with the ratios, what's happening with the actual indices, and we're going to talk about that too. But I, through the years, discovered that there's the US-centric market, and then there's a market tied to the global market. And a perfect example of what we're seeing now is the 6 stocks or so that have really been the reason why we haven't collapsed. Amazon, Apple, Microsoft, NVIDIA, Google, all the ones that are mentoring AI, but those are globally based stocks. I started to look at the US and I just said, what is the most important index and what are the most important sectors within the US? And I started to look at these over and over and over again. And I came up with the idea that, first of all, the Russell 2000 was probably more important than the NASDAQ. Not that the NASDAQ and technology and AI isn't important, but if you're looking at these 2,000 companies within the United States, it really represents the infrastructure, the industrial manufacturing side of the US. And for years now, the Russell 2000 have been underperforming the NASDAQ, and right now it's blatant. And so essentially, I realized that this was the granddaddy of the US economy. And I do have a picture there, so we'll talk about that picture. So that became my grandpa. And then I thought, okay, grandpa needs a wife. So what is also the most important aspect of the US economy, and not just US economy, but we're going to keep it US centric for now. And that would be grandma, right? Grandma retail. And that's because it's close to 70% of the gross domestic product is what consumers buy. And what I like is to use certain ETFs to associate so that I can look at a chart and I can understand the relationship of how I'm seeing them in their importance to the US economy, but also their charts. And then I start to picture them. So Grandma XRT is what I like to use. And that is a good ETF because that represents e-commerce, brick and mortar, consumer discretionary, and consumer staples, all of it in that basket. And then, of course, if you've got the manufacturing and the and retail as the supply, sort of, what's happening in the stores and inventory, what's happening in terms of what is being actually made in this country, you have to have things moving, right? So that's transportation. That would be the demand. And those three areas right there, Russell, Granny, and transportation, what Stanley Druckenmiller calls the inside of the US economy, because clearly just those three alone can give you a lot of information. But we know a family needs more members than that. So I started to realize, and this was years ago, that we needed to have a representation of the financials. But central banks and big banks like a Wells Fargo and a Bank of America don't necessarily represent what's going on in the rural communities. And it was striking to me that regional banks became the big news item this year. And I call actually the regional banks my prodigal son. And if I had more time, I could really go through the characters and why they've evolved. But this one to me is the most fascinating because he took center stage and because I had actually named him prodigal son, which in the Bible is the story of the son that comes home and squanders all his father's money and then comes back asking for forgiveness and gets it. This is exactly what we see in our banking situation here. Starting, well, I wouldn't say starting, but we could certainly look at 2008 as a classic example. And of course, what we just saw most recently. Then another member of the family is Sister Semiconductors. And that symbol is SMH, obviously from Silicon Valley, all the chip technology. Even though the whole chip technology started in Taiwan, we actually have done a lot of innovative stuff here in the US, and that's helped the economy, but it can never be the main driver as many people think. And then we have biotechnology, which of course is very important, our pharmaceuticals, the whole research and development space in biotech has been a huge driver in the US. Again, not the driver of the economy, but an important part. And our most recent member has been cryptocurrency, which I like to call the adolescent of the family because it's only 18 or 19 years old. And I think Bitcoin in particular, but all the cryptocurrencies are trying to figure out what they want to be when they grow up, how they are going to actually impact the US economy. So the picture you see to the right of that is my depiction of all of them, from Sister Semiconductors to regional banks to Grandpa Russell, Granny Retail, transportation, cryptocurrency, and biotech ringing the bell at the stock exchange. And now we're going to look at some charts so you can see how the relationships go. Please change. Okay, so what I decided to do, because we had limited time, and I really wanted to give you the zoom out look of the economy here. Sorry, I'm just fixing my mic so I don't trip over it. I wanted to show you a monthly chart. One of the things that I've been watching, I look at every time frame, right? So I will look at monthly charts, weekly charts, daily charts, half-an-hour charts, even 1-minute charts. And all of them used together, along with the backdrop that I just sort of dumped on you with the relationships, will give me a bias. But I still need a reason to believe in what's happening in terms of the technical analysis. And I've used these charts for years, but I have never, ever seen them to be as influential and amazingly accurate as they are this year. And that's using a 23-month or about a 2-year business cycle and an 80-month, which is about roughly 6 to 8 year business cycle. And we know typical business cycles run at about 6 years. People will say, some people say 4, some people say 5. I like to look at this 80-month. And then there are these little mini cycles within the bigger cycles, and they have not necessarily been as important as this year, but this 2-year business cycle has been incredible. And the reason why is that it has acted as a huge level of resistance on rallies, and while the 80-month moving average has acted as huge support. So what does the conclusion tell you? Exactly what I anticipated this year, which is trading range, which is basically the key to stagflation. And that's the situation that we're in the United States. People hate to use the word, but essentially what that means is that the economy And if you're looking at that first chart of IWM, our granddad just once again landed on that 80-month moving average as we came into this week, as there were more fears about the debt ceiling or whatever, it doesn't matter. Even if you lived under a rock in terms of media, you could look at this and say, we have certainly at least can take a breath right now, that along with the market internals. But if we break down under the 80-month, then maybe this recessionary fear will start to come to be. But that doesn't necessarily mean a crash. It just means we may test lower regions of the trading range, because we're looking here at 2023, but we haven't gotten quite down to the October lows yet. And it could stop there or it could go a little lower. But it's very key to watch Grandpa. The 23-month moving average, you can see, has been resistance there. And you're going to see in a moment, but not so much in another sector. And it won't be a big shock to you when we see why. Same thing if we move to the right in Granny retail, right? So Granny is holding that 80-month. Again, proving the consumer is not nearly as beat up as people have expected they would be because of inflation, because of higher interest rates. And actually the savings rate today, as I'm speaking to you, started to flip back up. So the resiliency in the face of everything is what you're seeing here in the charts, which is why I try not to listen to anybody, particularly the fringe people who are either super bullish or super bearish, because those people get attention. But this is really what I'm seeing as the more sane approach to trading, right? Is to look to see what's happening. And we can certainly see that it's being supported not only in the internals, but here on the charts. So what would have to happen in Russell and Granny? Obviously, we'd have to continue to see them hold this longer term business cycle that we've been in, by the way, for over a decade, except for the one blip during COVID. So it's been a sustained period of holding a longer term positive business cycle, but that doesn't mean growth. It just means we're stagnating. And then if we look at transportation, it's in a better position, right? It's bounced off with the October low, it's 80-month, but it still has been not capable of clearing that 23-month. Why is that 23-month important? Because it would start to prove to us that we're going from stagnation maybe into a little bit of a short-term expansion, okay? But we haven't seen that yet, except in semiconductors, right? So that chart, actually, we're a little bit higher. Semiconductors traded up to about 130 pre-market today. So it's really in line with the 2 months before around that high, but it has to hold here and start to get some distance. So what can we assume from that? First of all, semiconductors never got down to the green line below. I know you barely see it, but you can see it coming up at the end of the chart there. So while everything else was showing stress, the semiconductors and the tech has always been the flight to safety for the last several years and continues to be an area of growth. But it also tells you that we could possibly, especially if the Russell, Granny, and transportation behave, that we can see even more expansion in the semiconductor space. And so we know that those 6 stocks that have been forecasting things aren't so bad, they're not even impacted by interest rates, that can still go further. And let's go on to the next slide. So regional banks, there's your KRE, total difference, right? If you look at the KRE right now, they broke down under the 80-month. Look at how well that 23-month, that blue line worked. If you go back into 2022, it broke it really basically like in September after trying to be above it the month before. It had that one little peak up and then closed beneath it. It's never been above that 23 months since. So regional banks were already showing signs of stress even before the rest of the market really was showing the type of stress that this actually wound up putting on the market when we had that early March crash. And now we can see it's kind of bottoming here. It's actually trading a little bit higher, up at around 38, 39. And if we can get past the high of last month, which was around 42, it's possible that the banking crisis, at least for now, would be over. Doesn't mean it couldn't rear its head before, but that would be another positive for the market, right? And if we move to Bitcoin, this is what I mean. It's not following semiconductors and tech as many thought it might. It's not necessarily going on with the risk on situation, but yet it also held a long-term business cycle, when people were starting to think that Bitcoin was going down to 5,000, it stopped right on that 80 monthly. And if it takes out the 23-month, I think there's an opportunity for that to go higher as well. The one I'm going to go right underneath it because it completes the modern family is biotech. And you can see another interesting thing about these moving averages that you're seeing here, particularly in the biotech, is how they're being squeezed together. The blue line and the green line are not quite converging, but they could get to that point. What that is telling you is that if the biotechnology explodes either up or down, the more compression, the bigger the move out of the base or beneath the base. And right now, again, like everything else, it's sitting there under the 23-month. So stagnation, not necessarily contraction, but not necessarily expansion. And the chart I really wanted to show you outside of the family, of course, is the S&P 500, which is the great benchmark. And it too is sitting right under the 23-month, which why is a lot of people feel that if it gets through 4,200, we could see a rally. My prediction is that if that happens, and right now it looks like it could, we could see SPY going up to 4,400, perhaps maybe even 4,500. But guess what? It will be Grandpa Russell that will tell us whether or not that rally is sustained, because he, and I like to use it as a person, has a long way to go, just proved to us that he could hold the 80, but the 23-month is up at 195,200. Right now it's trading at around 176. That's a huge move for it to even be able to test its overhead 23-month potential expansion, which means SPY has room to run, NASDAQ has room to run, and then if it looks around and realizes that the rest is not really necessarily following, that could be, again, a top of a range, and then we would start to see the market fall. And that's kind of what I'm seeing right now. Let's move on. Okay, so why am I feeling stagflation and persistent trading range? This is the Cape model, which is very much relates to the Shiller. And essentially what it's showing is the PE ratios of the S&P 500. And if you take a look here, really basically what it's saying is that the norm, the 10-year norm, which is represented in black, is starting to come down. And so really what this is showing, if you take a look at the big line on top, is that if we sort of break that average, that long-term trend, that it means that right now we still have high PE ratios. We've come off the highs. I mean, in 2021, it was crazy, the PE ratios. We've come off of that thanks to interest rates, but we haven't necessarily really broken down, which means that we're still at elevated PE ratios. People who keep telling you that stocks are cheap, they could get cheaper, of course, they could hang out here. But essentially what I believe is that even if they get a little cheaper, it doesn't necessarily mean that we'll see PE ratios crash, but it doesn't necessarily mean that we're going to see them rally either. Because even after everything I just told you, it still makes the case here for these persistent trading ranges to continue. Let's go on to the next slide. Okay, so I love talking about commodities. As I mentioned earlier, I was a commodities trader back in the day. And of course, when commodities really went into a lull, which they're very cyclical, that's when really we started to focus more on equities. But in 2019, I did an interview with Stocks and Commodities before even COVID hit. And the ratio between commodities and equities was at a 100-year low. And I love ratios, right? Because when they get stretched like a rubber band like that, they are unsustainable. That rubber band is going to snap. And that is exactly what happened. Could have I told you that it was going to be COVID? Of course not. But I knew something would happen because we had years of producers producing very little because the cost of goods were so cheap. We had a full labor market. We had low wages. We had Mother Nature relatively cooperative. That has certainly changed over the last several years. And so all it took was one disaster. And of course, everybody's talking now that inflation has peaked. And clearly, that is probably true for certain levels of inflation that happened because COVID was so unusual. but that doesn't necessarily mean that it has peaked in everything. And so what happens with commodities, and goes back to my 2023 report, I wrote that we were going to go into a new super cycle of commodities. And so far, I look wrong, right? But this is why I don't want to abandon my original thought, because when I do that, very often, it gives me a bias and something to sink my teeth in looking for opportunity. And right now, that opportunity, we started to see emerge this week in energy. So if you look at this graph, and I have to move a little closer to see it, the red line, or maybe it's sort of a bright orange line, is the energy, and you can see where the energy got really beat up. If you look at the aggregate, which is the sort of orangey line, that hit a 52-week low. This is why people think inflation's over. But yet energy is coming back. Livestock, which is a big industry in the US, is coming back. Industrial metals are coming back. And the agricultures, which also have gotten pretty beat up, and as long as Russia keeps extending its grain agreement, that has helped. But also, any of these factors could put commodities into a super cycle again. And energy could start with energy. It could be geopolitical. It could be another natural type of disaster. We just had a huge rainstorm in Italy that washed out thousands of acres of farmland. In Pakistan, that happened earlier in the year. We had rice being infected. China's had major drought. Argentina has major drought. But again, what happens with these commodities is they sort of go to sleep, but this time this may not go to sleep for 40 years because it has absorbed the higher interest rates. And the Fed is starting to pause, as I showed you earlier, which means we are ripe for a situation, and we haven't even talked about the dollar. The dollar has strengthened here, but if the dollar weakens or the Fed pauses too soon, or geopolitics get out of control, or Mother Nature does something worse, any of these things could drive commodities up, hence the inflation part of the stagflation. Gold has obviously gone sideways right here after making its big run because the fear factor has been removed a little bit from particularly the debt ceiling. But nonetheless, gold is still trading very high relative to the rest of the market. And so we would be watching for that to take out recent highs as well as another sign, not necessarily as a flight to safety, but also as an inflation hedge. Let's move on. Okay, I don't want to spend a lot of time on this, but this is when things get dangerous, right? So the red line is showing last year in June, and the blue line is April. So you can see that right now, the year-to-year change, we did see still rising prices in fuel and gas and used cars, as opposed to the April CPI report. But we didn't really get much growth in transportation or food away from home or electricity or shelter or new cars. These are the kinds of things, like I'm saying, except for food, really that may not necessarily have a great reinflation. But I'm still very concerned about, particularly when it comes to gas and fuel oil, especially since seasonality-wise, we're getting into a higher consumption and a higher demand. Let's move on. The other factor we didn't talk about is wages. So this really right now is showing that even in the face of inflation, obviously inflation has driven wages up, but they've come off a little bit. And consumers are more concerned about inflation than what the numbers are suggesting, because consumers are out there actually shopping and they're not sitting in their white ivory towers crunching numbers, right? And so this could be a factor as well, something to keep an eye on if the labor department, which is still robust, starts to weaken, because workers, and we're already seeing strikes around the world and even in the United States, still need more money to keep up with the cost of inflation. So there could be another factor in terms of wage inflation. Let's move on. Okay, so we're going to switch gears a little bit, but just to sort of sum up. So what I'm really saying in terms of the summary of everything is that there's the big macro, right? The zoom out on the monthly that's still showing stagnation, not necessarily expansion. Certain areas could expand, and you're going to see them right here. While inflation may be taking a little bit of a nap, but not necessarily over, at the same time that the Fed fund rates have beat the CPI, which gives a message to the Fed that it's okay to pause. That's kind of where we're at. So we're getting a short-term rally right now, could last a little bit longer, but you got to keep your eyes peeled when you zoom out to what's really happening in terms of these little mini business cycles in terms of equities in the modern family. What's really moving here is what you're seeing in these key megatrends, right? So you've got communication services and infotech. And this is a little bit like the dot-com bubble in that anybody says they're doing AI and their stock immediately goes up. And of course, now, just so typical of what we see often here in the United States is regulators start to come in and say, we have to regulate. And that is something now that's being talked about. Will that affect the AI boom or not? Don't know. Do I think AI is here to stay? Absolutely. Do I think, though, that right now that relationship compared to the rest of the market is stretched? If you look at materials, basic materials versus communication services and info tech, what we've already learned is when you see one area of the economy growing so fast, but nothing is really trickling down to basic materials, infrastructure, not necessarily sustainable. But for now, it's been a real fun place to park some money and make some trades. Let's move on. I just wanted to show you the power of AI, right? So I put into my chat GBT, this is just a little fun here, India in the global markets, India investing in the global markets. And this is the picture that came up. And so I just thought, I'm no artist. I'm the worst artist, actually. And even the characters of my family were done by a professional cartoonist. But it is fascinating. And if you want to be, thrilled and scared at the same time, here's a great example, right? A non-artist like me can actually create an image that's really cool like this and not worry about, at this point, because of no regulation, copyright infringement, because I was the creator of it. In essence, I created this art through the technology. So I just wanted to show you that because I thought it was fun. Let's move on. All right, so I just, going to give you a little bit of information of how we look at things. So the CEO of my company is Keith Schneider, who also happens to be my husband. We met on the floor. Our partner, Jeff Bish, he's the president, also from the Commodities Exchange. And so we knew on commodities that if oil was rallying, eventually that cycle would run dry. We would follow the momentum, and then we would go on to the next commodity, if it was cotton or orange juice or copper, whatever, or sugar, for example, which also has done very well in the last couple of years. So that put us into a mindset that we like to follow the momentum, get out when the momentum has died, and then look for the next opportunity. But that's not what passive investing is about, right? And so when I talk about stagflation, this really shows you that if you were buying in 99, 2000 ahead of the dot-com bubble and did not get out, look how many years it took from 2000 until 2013, 13 years to start to make your money back and see that market grow. And look at the valleys. The valley we had at the dot-com bubble versus the valley that we had in the financial crisis of 2008, 2009 was really steep. And this is how most of the world, certainly most of the investors in the US, are told to invest passively. Sit through huge drawdowns and just wait or buy more. And yet that's not kind of what we're doing here. And we've never done that. And it's been a much better formula. So let's move on to the next slide. This is really basically our philosophy based on Commodities Exchange, that there's always going to be a bull market somewhere, right? So you can see, if you just look at the years, the divergences between the best performing sectors and the worst performing sectors. It's blatant in 2020, right? The best performing sectors went up 164%, while the worst were down almost 60%. And if we go into more, into the most recent ones in 2021 and 2022, there's the best performing sectors are doing better than they were a year before, while the worst performing sectors are doing worse than they were doing before. And that is really basically, I think, so simple And yet most people can't really grasp it. You go where the money is, and you get out when the money is starting to go away. Let's go on to the next slide. So, we have something called GEMS. It's a global macro model that follows economic sectors that are moving or global macro sectors that are moving. And I just wanted to show you an example of something that's been outperforming versus the S&P 500, and this would be the gold miners in this case. So you can see where the model has taken over 20% because that's how much the GDX is since 2023 March, when we first entered this position. The SPY is still basically flatlining. And that's really the advantage of having something more algorithmic on top of discretionary trading. Let's go on to the next one. So you can see, I just wanted to give you an idea of the type of sectors that we use. So in the market, everything from utilities to miners to staples, materials, oil, biotech, natural resources, et cetera. There's an interest rate component with the total bond market. The equities, we will go short the SPY through the SDS, which is the ultra short. And then, of course, with our ETFs, we take advantage of some of the more energy, financial, healthcare, semiconductor, tech. So we kind of cover the broad spectrum. And that's why I'm saying, if you look at this, you can pick out what's been moving versus what isn't. And that's exactly what these models pick up. Let's go to the last slide. And so we also cover a lot of commodities, right? And a lot of specialties. So these are things that we've been developing for 20 years. Keith is really the developer of all of these ideas. But essentially, you can see that we want exposure to agriculture if it's moving, or solar if it's moving, or volatility if it's moving, or being short volatility if it's not moving like we've seen lately. And also some emerging countries, regional equities like Latin America, or emerging markets, broad Asia. We're actually long Vietnam right now as one of the countries that we think is undervalued. We'll have a currency exposure, and as I mentioned earlier, an interest rate exposure. So when you're looking to invest, that's really, you want to be able to ask, if you're going to put your money with a company that invests, how are you in terms of your momentum? Do you have a trend strength indicator? Are you passive investors? Do you have risk parameters? Probably the most important thing. And do you take profits when the momentum starts to scale out? And really, basically, are you following wherever the bull market is? Because as we know, something is always happening somewhere. And next slide, please. That's just a performance cumulative return on using that type of formula. We have many other models and blends, but I wanted to show you this one because of its global macro and commodity exposure. And I think that's pretty much it. So we're ready to move on, Rajeev.
Thank you so much, Mish. One quick question before we get to the questions. If people want to reach out to you, where would they, reach out, and what would they need to know?
Well, Rajeev, I think
Priyanka,
there's one more
next
slide, right?
There's one slide. That's right.
Yeah. So if we go to that last slide, there we have it. Yeah. So we can keep that up while we talk. But yeah, if you want to talk to us more, we'd love to do that. We're very amenable to get on a phone, get on a Zoom. So we left the email, and also our names, Keith and Mish, and even our cell phone numbers are there, and office numbers. So anytime you want to reach out to us, we'd be thrilled to talk to you.
Fantastic. So Mish, by the way, I've been listening spellbound to your conversation. I think Vince Gilligan, who created the Breaking Bad series in New Mexico, which is where you are in at this point in time, has learned a couple of things from you in terms of storytelling. So congratulations. It's really, really fascinating to hear what you're saying. So from what I understand, I think it's the 23 to 80, the trading range, right? Whenever it breaks is when, things start to move. And that, I think, is what you're sort of broadly suggesting in this kind of an ecosystem, right? A couple of quick questions, though. So one is really this, what's happening in terms of macros right now, between what the Fed funds rate is going to be
Rajeev,
versus.
Talk slower, please. I'm sorry. Especially with the questions. Worries. I want to make sure I'm getting every word.
Absolutely. The debt ceiling debate, I wanted to get a little bit more of your perspective on. Obviously, we go into a period of uncertainty when there is a lot of talk about the US defaulting, right? And that spooks markets generally. What's your sense of where that story is going to land up, and does that have any bearing on how the markets are going to behave?
Excellent question. So first of all, as a US citizen, I've seen political footballing happening in the past very often. It's pretty much always in the backdrop here. And that's kind of how I feel this is. I don't think it would serve either party to allow that to happen. And so they're already in talks, and that's why the market's taken a breath here, because there's optimism. However, we did have 2011, which actually, after the market crashed about 20% and we got downgraded, was a great buy opportunity because you knew that they were going to come to agreement, as they have 78 times. So essentially, the bigger impact is not so much will they or won't they. I'm pretty sure they'll come to some kind of compromise, and we will see a disaster averted for now. But the question is, okay, they come to a compromise, they raise the debt ceiling for the 79th time. We have $305 trillion worth of debt in the world, not to mention a big chunk here in the US. What is the actual implication of that? To me, is far more interesting at this point. And I believe that is inflationary because, again, you are stretching the system. The government, regardless of all the QT that we heard coming into this year, regardless of the interest rate rises that we've seen, there has been a lot of liquidity keeping the system going, and government spending is clearly a big part of it. The banks are really the reason why the regional banks didn't fail. The central banks were actually helping out. And so as long as that continues to grow, you have the people who are the modern monetary theorists who believe that you can continue to do that until the whole country defaults. And maybe that's what happens. But at this point now, that system just, again, that rubber band, I love thinking about rubber bands because they're the perfect metaphor for when you start to see these relationships get so stretched. How much liquidity can we have based on everything else that is so delicate with inflation and raw materials and labor and social unrest and Mother Nature before the whole system goes? And that's basically the super cycle potential that I would not take my eyes off of.
Thank you. The next question, and this you briefly touched upon, has to do with the dollar. The USD, the DXY. I think I'm talking about it in broader macro terms. The dollar has enjoyed the status of being the trading currency for the world, and that has meant basically that the US has had that phenomenal position of being able to export and print whatever it wants to, and the rest of the world has to sort of fall in line. I think at least in the Eastern terms, if I look at just India alone, for the first time in our history, we are buying oil with rupees instead of dollars. We have never done that before in our lives. And that means $100 billion bill that we don't need dollars for, that we can sort of print our own money, which changes the paradigm for us clearly. But what does that mean to the US? Because obviously the US enjoys this, hegemony. And, how does that story pan out? Obviously the dollar still continues to be the world trading currency, but, where do you see the story going?
Well, this has been a topic on the table for 10 years now, where the dollar was going to lose its status as the world reserve currency. And certainly that conversation has gotten a lot more vocal and in the media, and with what you're saying with India and other countries as well, particularly in the Middle East, that are starting to want to price oil out in yuan, for example. And I think that's a trend, no doubt about it. But it's almost like, Rajeev, this is what I love about having that macro in the back of your mind, but having the ability to look and zoom out at a chart for market timing, because market timing is everything. You can get killed having an idea or a theory if you don't necessarily know when to time yourself in or out, and also when, obviously, even if you get good market timing, when to take a profit and what your risk parameter should be. And the same thing with the dollar, because I was at 114 saying the dollar is topped out, because you could see the voices were coming out more and more and more and more and more. And, you know, there a lot of damage was done just to American credibility because of certain policies that we've had through the years. And I don't want to get into that, but everybody knows what I'm talking about. So now here we are. Remember that 23 80-month moving average chart I showed you with the Modern Family? If I had given you one on a dollar, you would have seen that the 23-month, which the dollar has been above. So even though it's come off, it's still been in an expansion, really just tested the lower end of a 2-year business cycle and popped. So as far as I'm concerned, I want to see how much this rally sustains. Can we get through 103? Can we get through 105, 106? To me, that would probably be a great area to start thinking top again. But if we can't break down under, say, 100, let's call it 100 to 101, and I'm using DXY as the example, that would be, I think, meaning that whatever is happening, it's not enough to kill the good old greenback. And if we break down under there, yeah, then I would start to get nervous for a lot of reasons. Inflation would be probably my biggest concern. Inflation coming from what I like to say, looking at all the wrong places. You know, a devaluation of our currency would hit hard here.
It's now at 103.37. So, Mish, I think, there seems to be some grounds to believe that it's been popping again, as you put it, right? So interesting times indeed. The next question is about stagflation, right? It's been a long time since the world has been in a stagflationary environment, right? And I'm not very sure how many of us understand how stagflation would impact our assets, right? What would be your broad, advice in terms of understand whether we are in a stagflationary environment? I mean, that means range bound. And if that's true, then what would you do? It's basically active investing with basically buying at the bottom of the range and selling at the top of the range, or doing the reverse with is that it, or what would you recommend?
Well, you certainly mentioned two things that I would be looking to do. Is number one is this was a perfect example. Once the Russell 2000 proved that it was holding 170, let's say, which you could see was the bottom of that 80-month moving average, that we're not going into recession, bottom line, which is, of course, the definition of stagnation, because it doesn't mean we're going to grow. You could buy at that level and be more active. So right already, had you bought it around 170 last week, or even in the beginning of this week, it's gotten up to 176. It was over 176 pre-market. I'm not sure where it is right now, but that's a nice little trade. And you can look at things within that Russell 2000 or other things like basic materials. I like to look at that were so beat up. It's almost like saying, there's not going to be any use for steel. And so that's crazy. I mean, unless we're really going into a major depression, which certain people obviously think we are, like Peter Schiff, for example. But I don't believe that. And again, I'll let the charts tell me. So yeah, so you want to trade the bottom of the trading range, but you also want to make sure that you're nimble. In terms of what I showed you with the sectors that are outperforming, you want to find the things that are defying that stagnation, like what we're seeing in communication services and technology and AI. And in commodities, you want to really keep your eye on the inflation part. And if you start to see a lot of these commodities have come off, but they too are holding kind of like the dollar was at a 23-month business cycle. They've never failed the 80-month. They did years ago, but they came back through after COVID. That's telling you that they're still in a longer term cycle. So that's where you go. And you've got to really be like almost like a jigsaw puzzle. You have to constantly be looking at the heat map, so to speak, but not on a day-to-day basis, more on that's why I'm showing you monthly charts. You got to zoom out during a stagflation period. This is what happened in the late 70s. Like you said, we haven't seen this in a long time. I started my trading career right at 1980, just when I was young, very young. Let's make that very clear.
But right, you don't look a day over 25 even now.
Thank you, Rajeev. Right, so I started at about minus 15. And so, but I was great is that I got to see stagflation because the economy was stagnating. The Dow Jones Industrial Average from 1968 to 1982 traded in those 15 years within a very narrow range. Just like I showed you what happened from 2000 to 2013. It wasn't a narrow range, but it took a long time to start getting past the peak. Then it was the same thing. It was sideways, but yet it didn't mean there weren't opportunities that emerged. The opportunities weren't necessarily, though, in the typical places. And now with the 60-40 model completely blown apart with yields rising, it really behooves you to be a follower of either things at the bottom of the range, things that are breaking out because, and you can give them some kind of a good fundamental reason, like a commodity, for example. And like I said, be active, because anticipate the top of the range is not necessarily going to be a place where things are going to keep going like the old days. Everything's changed.
Fabulous. Couple of last questions. One has to do with the fact that you pointed that it's perhaps time for a pause with the Fed funds rate, very simply because now inflation is below the Fed funds rate, right? But if I look at the graph that you put up earlier, right, pretty much every year, 74, 81, 84, 95, 2006, perhaps not 18, but every other chart had a significant gap between the Fed funds rate and the inflation. CPI was half, and this was, so does that mean that they're going to stop, or does that mean they're going to continue to raise it until that, what they did in 1981 perhaps is the most extreme, 2010, effectively. Is that something that's likely to happen?
It's funny you would mention 81, because of course people are wondering if Powell can do what Volcker did. My sense would be no. I mean, this has been a very reactive Federal Reserve since Powell's been at the helm, and not proactive. So my feeling is that, first of all, they don't really look at CPI. They look at PCE, right? They look at personal consumption expenditure. And that has come off too. I believe that what Powell said at the last meeting was really basically, say what you want about him, but he's extremely transparent. And what he said was that they will consider a pause based on the economic data. So basically they're on a wait and see basis, right? Now I'm going more seasonally, that May often tends to be the peak. And also if you look at forward yield guidance in terms of where, let's say, junk bonds are, or even high corporate grade bonds, they are very undervalued to where they typically are, to the tune of anywhere from a 7 or 11% undervalued based on forward yield guidance, which means right now that the Fed does have at least the rationale to be able to pause at this point, especially as we can see, we are not expanding at all. Retail sales might have been a little bit more robust. The jobs market, which I think today we actually have a jobless claim number coming out, has been strong with pockets of weakness. But we could also see that commodities right now, if they're going to look at it and be more reactive, they're going to say, things aren't so bad, and they may pause for now. What I think could really happen is exactly what happened in 2020 and 2021, is it was so obvious inflation was going out of control, and they waited. They did nothing. And I think right now they have a lot of pressure on them in an election year to keep the status quo, so they could get caught behind the 8 ball once again. And that's kind of what I'm assuming.
Fabulous. One last question, Mish. In the beginning of your slide deck, you, at least a couple of your indicators pointed to the fact that the market is moving into risk-on mode, right? So, in terms of the SPX sort of outperforming the bond indices and, the high yield bonds sort of, you know what I'm talking about. Yes. Obviously, that sort of flies in the face of the market expecting a hard landing, a depression, a deep depression, and maybe a soft landing. Yeah, they are the scenarios that everybody's talking about, whereas it's now risk on. Now, how do these two square? What's your sense of where we are?
Well, I've always been somewhat, I take economists with a grain of salt for many reasons. The main two reasons are, one is they're not traders. I'm a trader. And so I know that Real Vision and you and many other people have come to rely on me to talk about the macro and the economy. But I always like to say, I am not coming from the ivory tower being paid by a company to basically support whatever economic condition they want you to support. Because you could scrub numbers and make them work any way you want. I'm a market watcher, so my economic predictions come from all these different things that I very briefly showed you all today. So getting back to the risk point, what's interesting is that it's supported to me right now a slight risk on environment, which means, okay, put some money in the market, because it also is based on commodities have come off, gold's come off, the dollar is strengthened, so it doesn't look like it's going to fall apart. And on top of that, we held the bottom of the trading range, proving right now that we're not going into some major contraction. We've absorbed the bullets, as I said in the beginning. Could that change? Absolutely. I watch these relationships, not every single day, because I get a sense of them, but every few days, and definitely before I begin the week, I will look at the SPY versus the TLTs. Just that alone. Forget about all the others for now. Just look at that one alone. If the SPY is outperforming while yields are going up, still those long bonds, it's telling you, whew, market's not so worried. If we see that flip and the bonds and the TLTs in particular start to rise above the SPY, that's a recessionary fear, right? Now, it doesn't necessarily mean that it'll get follow through, but it's really why we've been in this kind of really narrow range, because nobody really knows at this point. So these are clues. These are clues. They're not the end all be all, because things can shift, but they're clues that the macro, remember, let's start with stagflation. If you keep that in your mind, you're not going to get too bullish when risk on happens, and you're not necessarily going to get too bearish when risk off happens, but you are going to be aware of the fact that you have to be certainly more nimble in your investment strategy.
I'm going to just sneak in one a side question, which is basically a side question to the previous question, which came in from Umesh. The question really is, look, it looks like we are going to go into an earnings compression mode, right, in the SPX right now at this point in time, which could lead to a multiples compression, right, generally risk on generally means multiples expansion. Is that something that you would see? I mean, is that something that you're watching out for?
Did you say depression in the beginning?
No, earnings compression. Earnings are going to come.
Yeah,
that's
well,
right.
Actually, the earnings season has been better than what people suspected. There's just another example of number crunching. Is, to me, it's, first of all, it's past looking, it's not forward looking. I'm all about anticipating what's going to happen, not necessarily basing my scenario on what already happened, especially since what already happened is, as I said, square peg, round hole, right? Because everything that already happened is based on two things we have never seen in our lifetimes. One, obviously, the end of accommodative Fed, and two is a COVID and massive inflation and global disruption. But yeah, I mean, I think that that essentially right now with earnings, what it's telling us is that things weren't as bad. But that doesn't necessarily mean that they couldn't get worse. And it doesn't necessarily mean that they can't get better. If the Fed pauses here, you could see companies starting to do better, but you could also see those companies being affected by wages, because if people start demanding higher wages because inflation doesn't come down, that could hurt the bottom line. And a lot of these companies, particularly the bigger companies, are still doing a lot of stock buybacks. And that stock buyback is really impacting their bottom line for the better. And that too is a falsehood. It's not really giving you the idea, which is why I'd say keep your eye on earnings. But to me, that's never been the most important thing. And I know everybody loves to say, oh, what do you think about Tesla earnings, this earning? To me, what's more important is how it all fits into the step ladder of stagflation, risk still geopolitically, and inflation going further out of control, economic and the Fed, what happens with the interest rates here, what happens with the dollar, and then, of course, what pockets of the economy can actually make their way for any kind of sustained momentum beyond this persistent range. And that's really all you need to be looking at right now. Otherwise, it gets too complicated.
I just love the session. Thank you so much, Mish. It's been fabulous. I made a mental note to myself that we need to figure out a way to get you into India. I know you've not been India in the past. So we need to figure out a way to get you to India. So, that's something that we're going to definitely work on. In the meantime, thank you so much. What we'll do is we'll put up, your contact details on the posts that we make. And, we look forward to further engagements. I'm sure that I'm going to come back to you and ask for your expert opinion on what's happening in the future. Thank you so much. Really appreciate your time and, the deep insight that you've shared with us. We look forward to further such.
Thank you, Rajeev. I was so honored to be with you today. And thank you, everybody who listened. Yes, please reach out to Rajeev or me and happy to answer questions.